Welcome back to this channel for practice problems for actuarial exams. My name is Krzysztof Ostaszewski. You can find information about me at smarturl.it/Jedi. My advice on how to pass actuarial exams is at smarturl.it/pass. My YouTube channel can be found at smarturl.it/pass actuarial exams. My DTube channel is at smarturl.it/This Ain't Country Club. And my dlive.io channel can be found at smarturl.it/Go Pass Me Some Exams. You can find information here about online seminars that I teach for exams P, FM, IFM, and LTAM, and my study manuals for those. I direct the actuarial program at Illinois State University. You can find information about it at smarturl.it/actuary. If you would like to make a tax-deductible donation to support our students, please go to smarturl.it/help ISU actuary. Here's a problem for today for exam IFM. Determine which version of the efficient markets hypothesis is contradicted by a momentum strategy whereby investors can use past stock returns to form a portfolio with positive alpha. Positive alpha means that the return is given by the formula of capital asset pricing model. So the risk-free rate plus beta times the excess return of the market plus an additional term called alpha. Basically, investors could possibly use some strategy to beat the market on a risk-adjusted basis, which would contradict efficiency of markets. And there are three forms of efficient markets hypothesis. One is the weak form, the other one is semi-strong, and the third one is strong. If the market is strongly efficient, then it's efficient in the other two ways as well. So it's efficient semi-strongly and also weakly. Weak form efficiency holds. If the market is semi-strong efficient, then it is also efficient in the weak form. And the weak form is the weakest one. The weak form efficiency, if you want to get a very simplified picture of it, means that you can't use technical analysis to beat the market. And technical analysis means study of history of prices, so the entire history of how the stock traded and all these graphs that you see on financial channels, and also study of volume traded, so historical information like that. You can't beat the market using it based on the weak form efficiency of the market. Now, additional information that is publicly available is the information in the financial statements of the company. So the balance sheet, income statement, cash flow statement, the standard financial statements that the company publishes. And the semi-strong form of market efficiency is basically says that study of those forms of public information, in addition to study of history of prices and volume traded and so on, cannot be used to beat the market. And in simple terms, that means that fundamental analysis doesn't work. Technical analysis, the study of the graphs of prices and volumes and things like that. And fundamental analysis means study of the financial statements of a company or a security in general. And then the strong form of market efficiency is a statement that all of the information existing in the world is already embedded in the stock price. And the price changes only because of the new information, which is uncertain and unknown and as it arrives. And that means, in simple terms, that insider trading does not work. Okay? So, which version is contradicted by a momentum strategy? That's a strategy of following the trend in the market, basically. So the trend is up, you should be buying. If the trend is down, you should be selling. And this is a statement that technical analysis would allow us to form a portfolio with positive alpha. That contradicts the weak form of market efficiency, but if market is not efficient in the weak form, it's not efficient in any form. So weak form, semi-strong form, and strong form. So to recapitulate, the weak form of the efficient market hypothesis says that the record of past prices is fully represented in the current prices. So if one can realize consistent profits by trading on the record of past prices, this violates the weak form of the efficient market hypothesis. But semi-strong and strong market efficiency both imply the weak form of efficiency, so this will also violate the semi-strong form and the strong form. So we conclude that a momentum strategy violates all three forms of the efficient markets hypothesis, which is answer C. Please remember, this is copyrighted material. The problem itself comes from a society of actuaries. The solution is mine. Good luck in your studies and good luck on the test.